Axel, welcome to the show today.
Appreciate the invite, Michael. This is exciting.
So you've built a pretty sizable portfolio at this point. You've been doing this for a little while, but I'd like to understand back in the day when you got into real estate, what was going on in your life? Like, did you have some kind of job? Why did you start looking into real estate? So go all the way back and when you were thinking of real estate, what was kind of motivating you? What were you trying to do?
Absolutely. Yeah. So this is I'll take you back to right around 2016, 2015, 2016, so about 10 years ago. I actually got into real estate pretty early. So I was in college and always been an entrepreneurial guy. I was the kid selling baseball cards at the end of the driveway. And in high school, early college, I was buying and selling used cars. Like that was my way to make an income. That was kind of
You were
my
you were
side
flipping
hustle.
cards?
I was flipping cars,
Nice.
exactly.
Okay, cool.
And I don't know if I got a Instagram ad or if it was from watching HGTV or something like that, but was seeing one of the house flipping shows. But uh, uh, basically had this moment where I was like junior of college, like, all right, what are you going to do after you graduate? You probably want to start a business. You're not that unemployable because you can't really keep a job for more than a couple of days. And then I figured, yeah, why not try this flipping houses thing? That seems like a pretty interesting road to potentially go down here as a next step from flipping cars. So as I started learning about flipping houses, stumbled across rental real estate, multifamily real estate, the whole concept of passive income. You do the work once, you get paid forever type of thing. Started to really stick out to me as where I wanted to spend my time within the real estate business instead of flipping houses.
But you flipped some houses.
I flipped one house, and it was like it wasn't even a house; it was a condo. So,
Uh-huh.
my first deal was actually a small multifamily that I found as a for sale by owner on Craigslist. And then I flipped a condo, made like 2 grand, took a bunch of risk, and it was a whole pain in the butt. And I still wanted to do that because I had to figure out a way to make the chunks of capital to go buy rentals with. And what I ended up realizing was that I am not like the construction manager. That was not my skill set at all, but I was a really good like sales and marketing guy. So back in 2016, 17, 18, as I started buying deals, I spent all of my time learning how to find deals direct to seller, how to get in front of owners, how to send the direct mail, cold call, cold email, and then how to creatively finance them so that I didn't need those chunks of capital to go and buy them. So, I was doing a lot of seller financing, a lot of private money financing, basically using a lot of debt to get these deals closed, right? 90, 95, 100% financing in some cases. But because I was buying such great deals, I had all these lenders, private lenders that I was networking with that were comfortable with lending me that type of capital because we were buying deals at 70, 75% of value. Um, so long story short, that was the entry into the business and organically grew a rental portfolio that I personally owned and controlled, 70, 80 units or so. Now we're at 2020, 2021, but had kind of a moment of clarity of, do you want to just keep buying these small, like 3, 6, 10 unit properties and taking all this risk with all this debt and spreading your own capital out over a bunch of deals? And realized that wasn't for me, wasn't really a sustainable way to keep growing a portfolio. And that's when I found podcasts like yours, a handful of other ones, started getting active in some of the, some various networking groups, learned about joint venture partnerships and syndications and buying larger multifamily deals and all of that. And that's when we started raising capital. That's when I started partnering with some other investors because everything I had done up to that point was myself, my own money, no partners, and started to pour a little bit more gas on the fire and actually grow the actual business.
You're kind of a slow learner like I am, Axel, because I flipped three dozen houses before I woke up and it's like, man, this is kind of insane. You built 70 rental properties. Holy cow. I mean,
Yeah, yeah.
that's
My
pretty
version
impressive.
of it was just doing these 2, 3, 5 unit deals over and over and over and over again, and not going, 3, 8, 15, 50. It was just doing the same types of deals. Yeah,
For me, I don't know what my problem was in hindsight, right? Because obviously flipping houses is a very active thing. Like if you're not buying, fixing, and selling houses, you're not making money. You're making chunks of money. And
yeah,
and rental property is a little better because you're building up some amount of income and passive income, but it's so small, so little,
yeah.
right? Like why do you feel in hindsight it took you up to get to 7 units before you kind of went, oh my gosh, I can't actually scale this. The wheels are gonna come off.
Yeah, I mean it's a good question. I think if I'm going to be the armchair personal psychologist here and analyze my own brain, it was probably I didn't really feel comfortable taking that leap. I think for me, I found my little zone of what was working, which is like the direct to seller on these small deals. And I had a lot of fear around sizing up the deals that I was pursuing, specifically in the deal size. But what made me feel really uncomfortable at that time was working with partners or working with our investors. Couple reasons. One being I was afraid of losing money, right? That's an easy fear to have. The other one was, and this is the self-analysis here is I didn't really want to answer to anyone, right? The whole reason I liked being self-employed was I didn't like having a boss. And, investors are fundamentally bosses in a different flavor in a way. You are accountable to somebody else outside of yourself, right? If you're losing money, it's your own money. If you don't want to work on a Monday and whatever, it's up to you. And there's a little bit of a different dynamic that's introduced when you start taking investor capital. Same thing with partnerships, even just buying deals with one or two joint venture partners, and we're not necessarily maybe syndicating the equity and bringing in a whole bunch of LPs. But even then, I was a pretty demanding person. I was nervous about getting into a partnership with someone that didn't really work. And it took me a while to just get over that, right? And it was like eventually the writing on the wall was, dude, what you're doing now is just simply not sustainable. Like you can't keep cycling your own cash and buying larger deals because frankly, it was financially just extremely risky to be doing that, right? And I started to have a lot of fear keeping me up at night. Like I got 6 ongoing projects that were all calling different amounts of construction funds. I'm pursuing this new deal and putting down an earnest money on this one and paying for the third party reports on that one. And just managing my own cash was like not, it was just really hard to do that. And the epiphany I had was it's okay taking a lower percentage of these deals, giving up some equity in these deals so taking 2 steps back so you can take 5 steps forward and 5x the amount of units you're able to buy and just fundamentally operate with significantly less stress because you're raising all the money up front, you're funding the project at closing, and you're not working so hard to try to spread your dough across a whole bunch of different opportunities, deals, projects, etc. And I think it was mainly just like I got hit over the head with that one day where I was like, dude, this is not working, and that is what pushed me over the fear of working with partners and investors.
What do you think was your breaking point?
Um, I think the real breaking point was probably late 2019. I got into a deal that wasn't going that well. And specifically, it was calling far more renovation funds than I originally anticipated. Like one of those deals where it was, for me, it was 10 units, but 15, 20 grand per unit in renos that ended up becoming 25, 30. And it's just me personally funding that short, the shortfall in the budgeting or the budget that I had for it. And I'm just coming out of pocket funding this, right? And then I went and put another deal in a contract that I needed to put a big deposit down in order to win to win the deal and to make the seller feel comfortable. And I have 80, 90 units with a bunch of ongoing renovations, and I had like $1,000 in the bank liquid. And it's just like if one thing snaps right now, I'm going to be in a really tricky spot. And it was, and, this is the mentality that I had at the time because I was in my mid 20s. I was like 5 years in. I started doing this when I was 21, and I didn't have a family. I was renting an apartment with 3 guys. Like I was really comfortable taking really aggressive financial risks, but I kind of hit a point where I was like, this is just so clearly not the way to do this. And I would rather give up more of the deals and fundamentally, quote unquote, make less money, but not have the stress that comes with being able to pursue the deals. And I also hit a point too at that same time where I was like just tapped out liquidity wise with all of these ongoing projects that were calling capital. And if this refi doesn't close this week, I'm going to be in a tricky spot because next week I need the capital from that refi to go and pour into this new project type of thing. And the other piece of it too was I was really, really good at the finding deals, like really good at the direct to seller piece. And I had all these deals that I couldn't really pursue because I just didn't have the capital to even, just for the pursuit costs, putting them under contract, putting on the deposit, all that stuff. And I was like, no, I'm giving up deals because I'm afraid to give up half of this deal. I'd rather have this deal and own half of it than just not be able to pursue it at all type of thing.
So it sounds like most of your issues were around liquidity, right? And you're
Yeah.
taking on a risk by basically getting into non-recourse loans. I'm assuming all of them are non-recourse as well.
Oh,
Is
these
that
were all
accurate?
recourse. These are all PG
Or, I'm sorry, they're
loans.
all recourse. Yeah,
Yeah,
they're
yeah,
all
yeah, yeah.
recourse loans,
Yeah.
small
I wish they
banks.
were non-recourse.
Yeah, that'd be crazy. They were not recourse. So they're all recourse loans. So you're having liquidity issues. So you got 1,000 in the account. Like shit, I have to make the mortgage payment over here. And if I don't make that, then I'm going to default on this loan. They could come after your personal assets, all that stuff. So let me ask you a question. when you raise capital, there's a whole nother set of problems that you have to deal with on that side. So you finally crossed over. Looking back, if you had had a partner that, let's say, solved your liquidity issue around that time versus what you're doing now, which one do you think is a better option?
Yeah, I think if I were to go back and just be like, hey, implement this strategy to make this whole process a lot easier, it would have been finding one large LP or maybe a couple of larger LPs who were comfortable being purely passive and going to them over and over and over again for a lot of the projects that I was closing with some repeatable deal structure of we have this pref that works for you, we have the split that works for you. If it fits into this box, deal size, market, projected returns, you'll feel comfortable lending, and then we can just rinse and repeat. Now, the reason that I wish that would have been the better route to go was um, I was partnering with other active investors to get these deals done and giving up more of the deal than what was required because it's like, we'll both sign on the debt. We'll both split the asset management responsibilities. We'll both be actively involved, which not only means an active investor has returns that they expect to achieve because their alternative is I'm going to go actively invest and I know what I can make if I'm the one actively investing and running the project. I'm not here to be an LP. I'm here to earn active returns, right? So I'm networking with other investors who are active investors, and it's like let's partner on this deal. And as a result, we're divvying up the economics in a way to where I'm making a little bit more maybe because I'm finding the deal and there's value there, but we're splitting the asset management duties. We're both signing the debt when we both don't need to in order to qualify for it. I could just have been the guy signing the debt and have qualified for it. And they're bringing half the capital, I'm bringing half the capital, and I owned less of the deals that I closed for like a couple of years because that was who I was partnering with. And I wasn't going out there and purely raising capital from like a retail LP that wants to make their 16, 17 IRR or whatever it is and is okay with a smaller chunk of the deal. And the reason I would have went to a couple of larger partners too in terms of back then was I'm like mid late 20s depending on where we're at in the story, and like I didn't have the network of like retail LPs in terms of like I got 10 15 LPs who are comfortable doing 50K to 100K checks. And it took me a long time to build that investor base. And now we syndicate deals now and we raise capital to buy to buy most of the projects we buy now, and it is from a lot of those folks. But it took like 3 4 years of doing a podcast and growing an Instagram following and like actively building the machine that generated those leads. And back then it was like I didn't really have those folks. So I was like, I got to partner with the active guys. When if I was a little bit more intentional about who I networked with in terms of let me go find, the large high net worth individual that's comfortable investing 500 to a million a year, whatever the number is, or a family office or something, or a few groups, or a capital partner who is comfortable raising for our deals. But they're like, I'm the money. I'm not getting involved in the operational side. I'm not getting involved in the debt side. You can keep that equity, et cetera, et cetera. And the partnership would have been a little bit more clearly defined from a role standpoint. I would have kept more of those early deals, which then would have, the snowball would have grown a little bit faster as it rolled down the hill, metaphorically speaking.
So if you could set yourself down as a, 20, 21-year-old, all right, and what would you advise yourself? How would you have, now everybody, I'm not saying you have regrets, okay, but there's certain things I would have
Yeah.
done differently had I had myself or some other mentor sitting down with me going, hey, Michael, you should probably do this thing. What would you advise yourself and what would you have maybe done differently?
Yeah, I know it's a really easy answer, and people love to talk about it on the podcast. In the podcast, we're like, go bigger sooner, right? I'm gonna give a different flavor of that. I think the skill that at the time I even knew I had back at that time was like very good at this finding deals part, right? All these people are chasing the broker deals. I'm out here buying the $750,000 property for 550K. And one, pour way more gas on that fire, like more mail, more cold outreach, maybe expand into a different market or two with the same strategy. The big thing that I've learned now is like when it gets easy, like that's when you really go hard. That's when you got to put your foot down instead of taking a step back. It's like if you feel it getting easy, that's a sign that you got to do much more of what you're doing because it's really not supposed to be easy, right? It's supposed to be pretty challenging. So it was easy, so I would have done more of it. But at the same time, I just had this, we kind of touched on it earlier in the show. Like I had this arbitrary belief that like this only really works for these small deals. And to be precise, I was marketing to 2 to 10 unit owners in southern New Hampshire, an hour north of Boston, right? Like I live in Boston now. I'm from southern New Hampshire. This is an hour north of Boston. What I could have done is expand the market and done the same marketing to 10 to 50 unit owners, right? That's what we do now. We buy a lot of these kind of mid-sized deals that are $5 to $15 million in size, 25 to 75 units. Like we buy a lot of those direct to seller. For some reason, I just didn't think it would work. And there was no one that told me it wouldn't work. I don't know why. I just thought it wouldn't, right? So I would have leveraged that strategy and pursued larger deals. And the biggest thing I tell new folks now and we partner with a lot of newer investors that do this now, like in our market that we network with. It's like, I know you've only done a duplex and a 5 unit and a 3 unit or whatever, but if you find a 20 unit deal, all you got to do is just bring it to the guy who can put the money together and sign the debt and run it, right? And you get a nice chunk of equity. You get to ride shotgun throughout the whole process. And once you just see the process start to finish, and I'm talking like the literal tactical, like, so you email the syndication attorney, and this is what the documents look like, and this is what the process is to do a phase one report and a PCR and to go through the lending. Like all of that stuff is the amorphous, really scary stuff when you haven't done it yet that arbitrarily freaks you out because implicitly, I think a lot of folks trust the numbers who have some level of experience on the smaller scale. It's like if we confidently underwrite, the expense side and we use conservative rent projections and we know our market really well, probably will start to feel comfortable with the deal, but there's just a lot of stuff that you don't really experience until you do it. And I think the easiest way to do it is to just do one or two with somebody else, right? And it's not really hard to find that person. And that's what I would have done differently because I would have blown up the portfolio much faster.
You would have blown up the portfolio, but you would have created another problem, which is capital, right? Back in the
Yeah.
day when you're doing the small one, you're trying to use your own money, you're moving money around, and therefore you can't really. And you were using some private lenders, which is kind of cool. But had you done that thing, you would have created a capital problem. So how
Yeah.
would you have solved that? So yes, you can shift your marketing a little bit to the right and target bigger properties, but then you would have had to you would need much more capital. What would you have advised yourself? How would you have solved that problem?
I would have, if we're talking like, hey, we go find a 30, 50, whatever unit deal, that's a big step up from what I'd previously done. Obviously, you need capital the second you put it under contract, right? You need 50K, 75K, whatever the number is for earnest money deposit. You need pursuit costs, right? What I would have done is had conversations with partners at that time saying, look, this is what I do really well. I do this direct to seller thing really well. I can bring you deals that are not the BS daisy chains, weird wholesaler deals that have no value, or the broker deals where you're competing with a bunch of other people. Like this is my special sauce. I'll put I know how to confidently underwrite a deal. I'll put it under contract. Let's split the pursuit costs. Give me 30% of the GP for just bringing it, splitting the pursuit costs, what have you. Keep 70%, raise the money, asset management, all that stuff. Sound good? And then perfect. Now we can go out and do it. And I would have went and found it. Let's say it's 100 grand and EMD pursued all that stuff. All right, there's 50K that I need to put down, right? That's part of what I need to do here. Maybe I have a co-invest, maybe I don't. I would ask for a share of the acquisition fee, right? So ideally, not only by being reimbursed my out-of-pocket costs once the deal closes and the investor equity is invested and in the account, so I get all my pursuit costs back. Ideally, I'm getting a 30% or a portion, however you negotiate it, of the acquisition fee. Maybe I'm co-investing, maybe I'm not, it depends on the deal, what have you. But I should be pretty neutral from a cash standpoint, right? And granted, now I'm not going to see cash flow from that deal because all the cash flow is going to the investors to satisfy the preferred return. Maybe we refi in 18 months, couple of years, whatever, and we're getting a little closer to getting to the promote. And I know that, compensation for GPs is pretty backloaded in terms of, again, most of it when you sell it and you hit the promote or if you hit a nice big cash out refi. So in the interim, I still would have been buying the smaller deals, but at least I would have had the comfort in, hey, the next 30 unit deal I find, I'm going to be the one to close it, to sign the debt and to maybe raise a portion of the capital. And maybe I get a little bit of a bigger chunk. But at the same time, I think I'm a big believer in it's okay to pursue smaller deals because that has the shortest term impact on your personal cash flow to you. You can buy a 6 unit deal. If you buy a good one, maybe you refi your money out in 6 to 12 months if you buy a good deal. And now you're actually collecting some amount of cash flow on a monthly basis that at least allows you to build a business where you have some revenue coming in outside of those big capital events, like when you syndicate deals.
So Axel, it sounds like you had some kind of unreasonable fears about scaling earlier in your career before you really pivoted into some bigger stuff. What do you think that is for you right now? If you had to guess.
That's a good question. Yeah, let me couple seconds to think about that. I think right now the biggest fear in that's holding us back from getting to that next level is probably entering new markets. Um, Obviously, I know many people invest in multiple markets, anecdotally. I know, Michael, I know you do, right? I mean, I know many people do. And we actually have done a couple of deals in other markets. We did some deals down in Florida. Two of them, went really well. Another one, more or less a break even. Like it, we bought it at the wrong time in 21, sold it at a worse time in 23. But luckily, we got out of it pretty unscathed, and everybody got their money out of that deal. Two of the other ones we did extremely well on because we found them direct to sell and we kind of worked our process. Um, I've recently started to retreat back into our shell of doing these deals in Southern New Hampshire because we own our management company. We're vertically integrated. We have immense scale in a very, very small geographic area within like a 30-minute radius. And the advantages to that are immense. Like, it's so like we know our rent comes down to the penny, right? It's really easy for us to pursue deals there. That said, it's not a big market. It's like a 250,000 person county. So there's only so many deals you can even literally do there. Even if you're the most active investor there, there's a cap to really what you can do. So we're in this weird inflection point in the business where it necessitates us to go into other markets if we want to continue growing. But again, my fear is mainly I don't have the operational confidence in going into another market because we have such a good infrastructure locally. And for me now, it's like we got to go out there, and the way to do it would be we go work our process to find deals. We are credible buyers, so we can leverage some broker relationships because we have a track record just in a different market. We work our direct to seller process, and then we JV with on the ground integrated operators, and we start structuring that way till we have some scale, and then maybe we start doing our own deals. Um, but I will say, I think 21, 22, I think a lot of people learned stuff, and we did a few of those JV deals both locally and out of state that weren't that great. So it's the fear is like I shouldn't be throwing the baby out with the bathwater, right? You have to collaborate with other people to continue growing the business. But we retreated to like I just want to run our own deals. I want to do it with our own team, and now I have to break back out of that and embrace partnerships to bust into new markets and to actually allow us to grow at a much higher rate than we have the last couple of years.
The hardest part about expanding into a new market is it opens up a whole nother layer of risk, right? And I think the biggest one to dig out is usually your labor pool. If I had to pick like any one out of everything that does exist, you can go into a new market, especially if it's secondary. It's normally secondary, tertiary markets, and the labor pool can be absolute crap, and it's going to be very difficult to know that until you actually get into it, right? So
It's tough.
that's at least in my experience. I've done it twice. I've gone my first company. I went completely wide. I went in 10 different markets with 3,500 apartments, and there were some good things and bad things about that. Good things, I got to experience markets with tailwinds that I didn't know about before and see how good they really were. But on the other side, the bad markets were really bad, and we were losing money at times when no one should be losing money in multifamily. And then now the strategy has been go deep, but going deep in a major metro where now we have kind of unlimited deal flow in one of our major markets, Atlanta, once we broke in. And then we have like a secondary market on the side that if there's a deal that comes up, we'll go for it. Uh, Us like you have reservations about adding new markets unless we see an ability to scale quickly,
Yeah.
because then it becomes, all right, let's get the economies of scale up to a place where we can actually operate efficiently in the next market of our choice. And that's a whole undertaking in itself. It's not, you
Yeah.
can't just go and easily pick a property management company, go do a one-off deal without some foresight into, all right, what's the next one going to be after that? Because we need to build that up. So in your situation, you're a little bit lower to the ground. You're self-managing all these things. And to be able to replicate that in a new market, it's a big step. But
Mhm.
like you said, it may be time to figure that out. What I'm curious about, how have what have you seen that's different now in today's environment, managing and operating your sites than we saw like around the COVID era? Because it's changed a lot across the country, and I'm curious about what you're experiencing right now.
Yeah. Yeah. And then, again, context for listener, right? I mean, our management company manages about 800 apartments. Some of that's third party, a very small chunk. Well, less than half. About 500 is what we own in southern New Hampshire in this very small area.
Mhm.
All, almost all early 1900s built between 5 and 20 unit buildings. So scattered sites, small buildings, very operationally intensive. We've had to work really hard it's a very different business than just managing 500 unit complexes. We've got like 50, 60 buildings that comprise that. Um, and one of the biggest differences that we've seen, and we've been blessed in the Northeast because we haven't been hit with the same level of supply and expense side of the P&L changes as Southeast, Sun Belt, Texas, a lot of these different segments of the country. And we've had pretty strong, I mean, our rents have basically flatlined over the last couple of years. At least they haven't started going the other direction. And we've had supply in the Northeast, but just not at the same level as what, for example, we still own a building down in Florida. That's been a totally different challenge, right? Insurance, supply, et cetera. The biggest change in our market, though, and this was like, one of the biggest things that we had to really work on outside of, uh, uh, because it was such a change from what we were doing from 2016 to really 2023, was everything's about renewals now. Like that's the biggest thing operationally, I think, in any market really in the country right now, operationally is for a very long period of time, investors were almost welcoming move outs and trade outs because the bumps they were getting on new leases were so superior to what they were getting on organic lease renewals. And it was accretive to the property value to keep turning over units, even if you had a few weeks of vacancy, a few grand in turn costs. If you're bumping rents 7, 10%, well, that's actually downstream more valuable for the property. And then you can keep hitting these nice capital events and this nice sales price. And now what we've seen is we've spent a lot of time internally, and obviously, we still care about renewals. Or we did care about renewals at that time because if you have a stabilized asset, you still want to prioritize renewals, but it wasn't as critical of a business function as it is right now, where now our lease trade out might be even, right? We might just be tenant leaves at 1700 and we're moving a new one in at 1700 and maybe like 1725 or, a couple percent, 1% increase, something like that. But we have all of this vacancy and turn cost. Uh, so we've spent a ton of time internally, like really, really optimizing our renewal process. Proactively asking if there's any maintenance issues 120, 90 days before the lease expiration so that when we ask 60 days, they have this nice feeling about their experience living in the building. Incentivizing with concessions, sometimes lease renewals. Um, you
And
know,
guys,
th-
by the way,
yeah,
the reason he's saying this is because you're actually experiencing right now negative lease trade outs, which is something that
yeah,
so basically like whatever you rented the apartment for like a year or two ago or three ago, whatever you're if someone moves out and you have to move someone back in, it's less than that amount, whatever you rented it for before. We're experiencing it. A lot of people are across the entire country. And people are saying it's mostly due to oversupply that still exists for right now, but it's just a phenomenon that we were experiencing the opposite of during COVID.
yeah,
Um,
exactly. And it's funny. Like you can look at deals now where there's, everyone, the whole thing in the value add world is loss to lease. Why, the rents are lower than where they should be. How far away? What's the delta between the two? Now there are some deals where it's the other way. There's gain to lease,
Gain
right?
to
Where it's
lease. Yep.
if
Hmm.
those tenants move out, you're actually leasing at a lower amount,
Hmm.
which is for the people that have been in who got into this really anytime after like 2011, 12, or whenever the depths of the GFC. It's like you have to completely unwind how you look at deals. Um, and for us, we do a lot more longer lease terms, right? 16, 18-month leases now. And I never wanted to do that for the first 8 years of being in or 7 years of being in real estate because it's like, I don't want to lock in this rent for a year and a half, 24 months because I want to be able to, I know that we're probably going to get a little bit more movement rent wise, and I want to be able to keep bumping them and staying close to market. Whereas now I'm comfortable if a tenant's open to it. We're offering multiple different lease terms on our trade outs. Here's
It's
12 months.
defense.
Here's
You're
exactly.
playing defense right now.
Yeah,
But
100%.
what's causing that in your market? I mean, in our market, we do believe it's because of oversupply with using the free COVID money back in 21 that now are coming to completion. and it affects some of our properties. For example, in your market, you said there was not that much construction going. Are people maybe moving, leaving the area? Is that what's maybe driving that? What is that? What is causing that in your market?
Yeah, I think well, I think the first thing in context, New Hampshire, highest population growth in the all of the Northeast US. It's one of the only states in, basically Virginia and North, about 10, 12 states that has positive population growth. Massachusetts, New York, Connecticut, Rhode Island, like negative population growth. New Hampshire, no state income tax, no sales tax. It's a very low cost of living state relative to its neighbors. So there's still growth, but I think the big thing is that we primarily buy C class deals. 75-80% of what we own and operate is C class. I think C class over the last couple of years has been very affected or significantly affected by just inflation, cost of living increases. There's less disposable income, generally speaking, in that resident demographic than A class, B class. And therefore, it's hard to continue pushing rents because the income is maybe not there in some markets where the income growth hasn't maintained in order to even pay elevated rents or rents that continue to grow. I think that's part of what's happened in our market. I think household formation is something that not a lot of people talk about, where when people are trying to save money, people move less, like just fundamentally, right? People stay in a roommate situation longer. Boyfriends and girlfriends maybe move in sooner than later. And instead of two guys who live in a two-bedroom apartment doing well and moving out and each getting their own one bed, they stay in that two-bedroom longer. So when there's less moves, there's less demand from a rent standpoint, tenant standpoint, and therefore I don't think you're able to continue, pushing rents at the same level that you once were. So I think that's a significant change in our market. And I think that's probably consistent nationwide. And even in our market where we still have a bit of a housing shortage and there less supply has been added in terms of like as a percentage of the overall housing stock as some of the more high supply markets, we've still had a lot of supply despite that, relative to what is normally built in our market. So a lot of that's getting absorbed now, and we're starting to see rents. 2024 in New Hampshire, we had a few percent rent growth. So over the last 12 months, we're starting to come back a little bit. In 2025, in a lot of our trade outs, we're seeing year over year increases now in growing tenant demand. But I think the formation piece of it's probably the big one. When people are unsure of, maybe their consistency of their income and they're spending more on other things outside of rents, you're not as excited about moving, and especially increasing your rents if you do move.
What is your next stage of growth, you think? I mean, stage one, of course, is if you getting into these deals using your own capital and then growing up to 70 units, which was pretty cool. And then you had a big breakout as you started JVing and syndicating a little bit more. And now I sense that you feel like you're kind of limited a little bit in the market that you're in, and you feel like you
Mhm.
want to go into another market. What do you think that looks like? If and how how much do you want to get to that next level of stage growth? Because that's another thing. I mean, do you want to grow for growth's sakes? Is it really, do you want that? Do you want to get there, right? Or simply just
Yeah.
hold on what you got right there and life's pretty good? Or do you want to get to that next level? And what would that look like?
Yeah, it's a great question. I am a big fan of thinking, with the end in mind. Like, what is the ideal end state and working backwards? For me, I never really had the dreams or goals of running a, 25 person speaking strictly about the investment company where a few investor relations people and multiple asset managers, and we're overseeing 4 or 5 thousand units and we're growing a very large enterprise. I don't like being a manager. It's just not really my skill set. And that's the biggest thing I try to work on now that I've got a few people in the business. And now that luckily I have an operational partner in our PM company, like it's separately branded in-house, but I own it with a business partner. We have, I don't know, 21 employees in that business now, but he's running the day to day and I'm more of an advisory role kind of behind the scenes. Um, I used to think that's what I wanted. And then as I started managing more and hiring more, I just realized like, you're not, that's not really your special sauce. Your special sauce is like finding the deals and really building a good engine to do that. Creating the content, marketing, etc. So that's what I want to lean more into now. I think the next stage is we continue to maybe buy a similar, we buy anywhere from 150 to 250 units a year. Average unit count of the buildings that we buy being anywhere from 8 to 12, right? So it's a high volume of these smaller deals approach. My goal is to slowly shift away from that and to increase the average units of the deal that we buy. So we bought a 72 unit end of 2024 which is about a $16 million deal. And that was the biggest deal that we had done individually up to that point. It was a $5 million raise. I raised about half the equity. I had to bring in some other folks to help with the other half. So for me, it's like maybe slightly lower volume of deals, slightly less paperwork, and do 5, 10 kind of these mid-sized deals, 50 to 100 units in size. And I think we can do that in our current market, and to raise more of the equity required to get those done and to kind of own a bigger slice of the pie of those. And then after that, it's probably layering in just like maybe 1 or 2 more northeastern markets into the equation that are within an hour and a half drive of Boston. I know that I'm labeling my own limiting belief here of like, it would be good to head south and maybe farther down the coast into a market that's a little bit, or that's, uncorrelated, or however we want to define that, with what's going on up in the Northeast, whether that's like North Carolina, South Carolina, Florida, et cetera. Kind of pick one geographic area that's maybe a little different than the Northeast and go a little deeper there and build out a team there. But for me, it's probably easiest to just build in another region within New England, because New England, early 1900s housing stock predominantly, even a lot of the larger deals, stuff that's 100 unit. We looked at a 100 unit deal as a 20s build, and we were close to getting it, but somebody else paid more than us. So like we've gotten pretty good at like owning and operating that kind of that stuff that's a little trickier and a little hairier to own. So I think that's probably the next step for us. But for me, like the end game is 5, 10 person team, a couple of acquisitions guys, investor relations, admin, asset manager to something like that. Maybe we own a couple thousand units that we have a real meaningful percentage of the promote on, and in growing a business that serves the lifestyle a little bit more than my lifestyle revolves around the business.
That's a good point. You got to ask yourself, what do you really want? I mean, there's people who just want 10,000 units to just like the idea, and then there's other people who really want to enable their lifestyle. And I think you got to figure out where you want to be. The good news is that we have options, right? You're in a good position with 500,000 units, whatever. You can continue scaling if you want, or you can say, hey, I'm just going to stay here and just enjoy the cash flow and just and do what I want to do. And so I think the cool thing about it is that it does give you options, and that is one reason I like this business. But Axel, how can people connect with you, find out more about what you're doing?
Sure. Yeah. Businesses Aligned Real Estate Partners. AlignedREP.com is our website. If you want to find me on social media, at Multifamily Wealth is my Instagram. I'm very active on there, posting a lot of content. The Multifamily Wealth podcast is the podcast. Michael's was on that a couple of weeks ago. I think we released the episode maybe 2 weeks back. But new episode every week, deep dive on multifamily specifically, operationally, finding deals, raising capital, all that fun stuff. Lastly, if you just want to reach out to me personally, Axel, AXEL, at alignedrep.com.
Awesome. Hey, Axel, thanks so much for coming here, sharing your story, going back all the way in time and kind of sharing your struggles with us. And it was great to learn how you scaled to this place. So awesome. Thanks for being here today.
No, appreciate the invite. It was a blast, guys.